All right, good morning, everybody. Welcome to the Financial Brokerage Webinar, Linked Benefits, the new way to purchase long-term care, presented by David Corwin and myself, Brian Lysing. We are marketers here at Financial Brokerage with more than a decade of experience here, each of us. And if you're not familiar with Financial Brokerage, we are a national marketing organization working primarily with independent producers nationwide in the areas of life insurance, long-term care, annuities, disability insurance, and now Medicare supplements. But this morning we want to talk about these linked benefit plans, why they're so popular, what the appeal is to consumers, give you an idea of how they work and the different types and styles of products that are available. Working with well over 40 carriers here among all of our product lines, let me tell you, there's a lot of different ways that companies have come up with to give clients this sort of coverage. So we'll get into it here. This will go a good half hour. As I mentioned prior to the start, if you have any questions, you can type them and we'll get to them at the conclusion of the webinar this morning. So what are these linked benefit products? Well, they're essentially life or annuity contracts that have some sort of a long-term care benefit attached to it. And they are becoming more and more popular every year. And we'll get into some of the reasons why, but certainly there's a huge need out there for this sort of coverage, or really any sort of long-term care coverage. We know that the high costs of extended care pose the greatest threat to our clients' assets should they become frail or ill as they age. Nothing is going to wipe out their life savings faster. And look at the cost. And this is, I think, from about 3 or 4 years ago now, so I'm sure they've gone up. But the median rate for skilled nursing care is $81,000 nationwide. If your client doesn't need a nursing home, they want to go to an assisted living facility, it's about half that, but still at about $40,000 a year. Same thing for home health care. I'm sure it's well over $40,000 now, and that's not for 24-hour care. Look at that statistic. That's for a 40-hour work week, 8 hours a day, Monday through Friday. You're going to have to pay for somebody else to help you out in the evenings and weekends, or more likely it's a relative that's doing that, and they are usually unpaid. So this is a huge burden on our clients' retirement incomes and retirement savings. So what do we do about that? Well, there are several solutions out there. Now, in the past, we could really only offer traditional long-term care insurance, or help our client build up as much money as possible to cover that cost. But that the way the costs are increasing, it's almost impossible. So insurance is really what we do. Well, the problem with traditional LTC insurance in the past, we've seen premiums increase. We've seen carriers exit the market, and that means there's less competition. That means premiums go higher, and the burden is not spread very well among different carriers. And as a result of several things, sales have been just steadily decreasing over the past 10, 15 years or so. So what do? People still need the coverage. The risk is still out there. Well, we have seen the opposite happen with the linked benefit plans. We've seen sales increase each and every year nationwide. In fact, I should probably update this chart, but you can see here the gross premiums in billions. And these are for the life insurance-based products. I mean, in 2006, we weren't even at $1 billion. We weren't even at $500 million. And last year, I have numbers for 2013, $2.6 billion went into some sort of a linked benefit product. So this is what your clients are interested in right now. If you're not bringing this up with them, I guarantee you somebody else is, to the tune of $2.6 billion. So you want to make sure that you're the one getting that money. Now, what makes these products so appealing to clients over, let's say, a traditional LTC plan? Well, I found that there are really two basic reasons that clients gravitate towards these products, and they're both guarantees. One is a guarantee that their premium will never change. If you talk to somebody about traditional long-term care insurance, they probably know somebody, a friend, a neighbor, a relative, a former coworker who faced a rate increase. And it wasn't just 2 or 3%. It was probably 25% or 50%. And they're mad as heck about that. A lot of people just drop the policy altogether. That doesn't do them any good at all. So people like the fact that their premiums are guaranteed to stay exactly the same. And the other real important guarantee that clients gravitate towards is the fact that a benefit is going to be paid out no matter what. A big complaint about, or an objection, I should say, to traditional LTC insurance clients will give you is, well, they'll say, well, what if I pay all this money and I never need to use it? I die in a car accident. I die in my sleep. I don't think I'm going to use it. I don't want to pay that money for it. I'd rather give that to my kids. And you really can't argue logic with them. You can try. It doesn't work, though. I mean, your chances of needing LTC for folks that are 65 and over, I think it's about 70% now, according to the latest study. So your chances are you're going to need this. But logic doesn't work when convincing a lot of clients out there. But so they like the fact that a benefit's going to be paid out. If it's a life policy, you either use the LTC portion or your family gets the death benefit, or there's some combination thereof. Same thing with the annuity. You either use the LTC benefit or the money is there for your use for other reasons, or it would ultimately pass on to the next generation. Whether we're talking about a life product or an annuity product, some things that these products have in common, they're all filed as fixed insurance products with your particular state Department of Insurance. And that benefit that's out there is accelerated to your client for LTC expenses ahead of when it normally would, so ahead of passing away, let's say. And the qualifiers for the benefits are the same. All the client has to do is lose 2 of 6 activities of daily living or have severe cognitive impairment such as Alzheimer's, and they'll qualify. Now, there is a little distinction with some of the life insurance riders. Some of them have one additional qualifier, which I'll get to later. But whether we're looking at the life or annuity products, these key elements are all shared by all the product lines. So I should have mentioned this earlier, but I mentioned David and I are going to be co-hosting this webinar, so this is the part where I turn it over to David, and he's going to talk a little bit about how you can find prospects for these products, and he will go into great detail in the annuity-based products. Then I'll come back and give you some details on the various life insurance solutions that are out there.
Thanks, Brian. I appreciate it. Thanks for joining us. I love doing these. It's exciting for me, I tell you, because I've been in the annuity marketing department for so long, and to learn about these things is really good. And I know not a lot of agents like to talk about this stuff, and it's almost a challenge for them to learn about something new, to shift really what they're doing. Because you have the typical annuity producer that's all they do is they talk about equity indexed annuities or fixed annuities. Well, there's a different product line there that you can look at, and that's really what we're talking about here. But the prospects that I typically see for this are ages 50 to 75. I mean, sometimes I see some 80-year-olds, but usually the typical prospect is between 50 to 75. They typically prefer to self-insure. So those individuals that are out there that would rather just, like I said, self-insure, those are great prospects for that. You have a lot of people with lazy money that are out there on the sidelines that may have some money that's maybe in a CD or checking account or maybe even savings accounts, money market accounts, anything like that. Have concerns about the ongoing long-term care insurance premiums. I know Brian talked about that, where the increases are all over the board when it comes to the standalone long-term care insurance policies that are going up by leaps and bounds there. Also looking for additional coverage to an existing long-term care insurance plan. We would never, I'm sure Brian would say the same thing, is that we'd never encourage one to replace a real good long-term care insurance policy with one of these that we're going to talk about. Of course, you'd want to look at it, but generally speaking, you wouldn't want to do that, and we would never advocate that. But also would want to maintain some control and flexibility. So that's the other thing. The long-term care insurance policy just by themselves, there's really no flexibility. With these plans that we're going to talk about, specifically the annuity ones that I'll talk about, you have access to the other pool of money that's available. And speaking of that, where's the money? So you have in the business market, you have non-qualified deferred compensation recipients, you have bonus recipients, you have recent sellers of businesses and farms. So really, and the last 2 slides have been pretty much anybody, but really it's just kind of get you an idea to start thinking about your prospects and where they have money at. And you always want to ask questions like that. So you have individuals and families with return of premium on DI and term life insurance policies. So the return of premium that's available out there if they don't want the policies anymore. Permanent life insurance policy holders that no longer need the insurance. So you have some cash value that's in there that they could 1035 exchange into one of these things. Deferred annuity owners, so you have the 1035 exchanges into one of these type of contracts. People with CDs coming due, homeowners that are downsizing, and then you have the recipients of death benefits. Types of linked benefits, you have annuity-based that I'll be covering, as well as the life-based that will be covered by Brian, but they're really single premium or flexible premium. Of course, depends on the type of product, but it is available for either one of those, single pay or a multi-pay. The benefits of the annuity chassis, if you will, is the funding resources that the client may already own an annuity that can transfer funds into the annuity. So you can't go from annuity to life, as you know. You can go annuity to annuity, life to annuity, and of course annuity to annuity as well. Inflation protection. Products provide 2 to 3 times the accumulation value for the long-term care insurance benefit. The underwriting, that's where these annuity-based ones, as opposed to the life ones, really there's fewer underwriting requirements because you're really underwriting for morbidity, not the mortality aspects, which is what's included on the life insurance one, because they don't have a life insurance benefit. It's basically annuity as well as a long-term care insurance pool. So it's a little easier to qualify for an annuity-based one as opposed to a life-based one. I'm not going to really talk too much about the Lincoln Financial one that you see on this slide here, but I will be talking about the Annuity Care 1 and 2 that's available with State Life, One America. Covering that, also I'll be talking about the income rider version of these. These have actually came out last couple of 3 years, I think, where the income riders that have been available, on equity indexed annuities, have been available for probably 4, 5, 6, 7 years or so. And then the last 2 years, they've included a long-term care benefit where the actual income payment doubles. And that's been very popular because, talking about the last slide of being some underwriting, these have no underwriting at all. So that's where a lot of these sales have gone to, where the individuals aren't exactly health qualified to get one of those long-term care type contracts. So I'll be covering really I'll be talking about the American Equity one, but the lifetime income benefit rider version of that. But there's also the North American Income Pay Rider, Target Horizon with Athene, and the Spectrum Mark with Fidelity and Guarantee. There's some others as well that I didn't include on here that we can talk about at a later date. But just for time's sake, I just wanted to put 3 or 4 of them on there, and also just let you know that there are others, and will be others to be added too. Because they're always adding different features and benefits to it. It makes it more sellable. But the State Life one, it's called the Annuity Care 1 and 2. Product features are they're issued as a single life or joint life, dollar for dollar benefit. Long-term care benefit grows at a higher percentage rate. Typically, and it's hard, I don't exactly know the rates on that, but they do typically, what I've seen, the long-term care fund does grow at a higher percentage rate than the actual cash account does. No medical exams and liberal underwriting, so it's a little easier to go through the process there. Option to purchase a rider to extend the benefits for a lifetime, so that's we call it the option to purchase rider, the extended benefits rider, but the Annuity Care 2 actually has that built in, so that's what's nice about that one. American Equity. So we'll talk about the lifetime income benefit rider, and there's others, like I said before, that offer some things, and they're a little different. But the highlight there is there's no underwriting. I'm not saying that's the reason why you buy it, but that's why I put that on there, just to kind of highlight that. But they have 2 different versions: a 5.5% growth rate for 20 years or a 6% growth rate for 10 years. Those are compounded. So when it comes to you have to actually have the policy for longer than 2 years, but the income payment does double. And you'll see on the next screen here where the payment does double if they can't perform 2 out of the 6 ADLs. And just some things here on the eligibility. Of course, I want to say this is that cannot be confined at the date of the contract issue. That's kind of one of those things you would think about, but I just want to make sure I cover that. And as I said before, the benefits must begin no earlier than the 2nd year of the contract. So this is, hopefully you all can see this. This is, I think it's a $200,000 purchase into their #1 selling annuity product called the Bonus Gold. It's what everybody sells. It's a long surrender period, so there's some things there you might want to look at. And this isn't an end-all be-all for everybody, but this is just an example of what I see. So a $200,000 purchase payment going in. This is a 55-year-old individual and waiting until the age 65 to start their income. If you see that second from the right there, that lifetime income benefit rider payment column, where their $18,413.80 cents would be their actual income payment. But if they can't perform 2 out of the 6 ADLs, well, then that would double to that $36,000 and change there. So that's just that's an idea to look at. I don't say that this would be, like I said, the end all be all. You know, there's some other things to look at, because this would only last for 5 years. That's the thing too. On this previous slide, I'm not sure if I mentioned that, but the actual double payment only goes for 5 years, and which is probably more than what the average stay would be. But there's other ones too. Going back on previous, just to chat a little bit about the other ones that are out there. They have a confinement eligibility requirement. Usually it's 145 days of the last 250 days you have to be confined for the payment to double. Some of them even have a tripling effect too, and you're wondering, why didn't I show that to you? Well, that's something we can talk about at a later date. It's offered through Athene, and it does have a tripling effect, and some other things that are on that. But I tend to gravitate towards the standard 2 out of the 6 ADL. That just seems like that's more understandable for people to really get. And it's the language that long-term care has. So the 2 out of 6 ADLs is typically what I like to talk about and go through with the agents that I work with on a daily basis. But I said before, I challenge it to look at these things. If you are an agent out there that will just write annuities and that's all they really understand, because that's really the way I was maybe 2 or 3 years ago. I just really didn't talk too much about long-term care. Maybe it was something from my vantage point. I didn't have a lot of experience with that growing up. Maybe you didn't have a grandma or grandpa that experienced this, or maybe a mother and father that ever experienced this. But just something that in my talking with agents just never really brought up. And now I am, and I'm glad I am, because it challenged me. So I think that's the end of my presentation here. This will probably be more about what the life hybrids are all about. So I'm going to pause it for a second here. I'm going to go ahead and get Brian on the phone to talk to you about the life hybrids. Okay, thanks a lot.
All right, thank you, David. I appreciate that. And this is Brian Lysing back with you again here. And now that you're well versed in all the annuity-based linked benefit products that are out there, we're going to concentrate on the life insurance products that the carriers offer. And I like to divide these up into 2 main product types. There's the single-pay products and the multi-pay products. Now, the single-pay, these are the original hybrid policies. They were the first out on the market probably around the year 2000 or so. And they do require a relatively large source of funds. And I think the national average premium going into one of these is only really about $75,000. They don't work well if you're looking at less than $50,000, and they look really good if you can get over $100,000. And then we'll also talk about the different multi-pay models that are out there. It's a little newer and more popular by far. I think 75% of the linked benefit policies being written, according to LIMRA, are of the multi-pay variety, and it obviously appeals to a much broader market. There's a lot more folks that can pay a monthly premium than there are that can come up with that larger lump sum. But we'll talk about all of them here as we go through this. I want to give you an example of how one of the single pay products might work. I use one of the more popular ones we have available here at Financial Brokerage. This is the Total Living Coverage product from Genworth Life. And just give you an overview of how it works. This client here, who happened to be a male age 60, had $100,000. And when I plugged that into the software, the $100,000 provided him with just over a $200,000 death benefit. So if he never used the LTC portion and passed away, he's doubled the money going to his heirs, and it's all 100% tax-free. Not a bad deal so far, especially if you have someone who's self-insuring or might be looking to pass wealth on to the next generation. Now, if he is self-insuring, he's got the $100,000 socked away. What we saw at the beginning, that's only going to last him maybe 2 years if it's home health care, and barely over 1 year if it's in a nursing home facility. Well, with this product, he actually has the ability to get 6 times the coverage for an LTC event. That $100,000 turns into a pool of $629,000 available for LTC for this gentleman. And again, if he never uses it, hey, he still doubled the money going to his heirs. We have a few other carriers that do something very similar, and the ratios are also very, very similar. So I had to choose one, though, to put in as an example. Now, the funding sources, David touched on this earlier, but this will be sort of a recap. Now, there are some folks out there that will tell you if you're able to get to all their assets, they've got $100K sitting in the bank in a CD or in a savings account. And if you ask them what the money's for, they're going to say, well, that's my emergency money. Turn right around and ask them what emergency is going to cost you $100,000 or $50,000. Let's see, do you have your house insured? Yes. Do you have your cars insured? Yes. Is your health insured? Maybe they have Medicare. Yeah, they've got that taken care of. Well, you could have every appliance stop working in your house at the same time on the same day, and replacing them would not cost you $100,000. Or if it is, I'd really like to see how those appliances work. They probably cook dinner for you. But at any rate, the real emergency there that they're worried about is a long-term care event. And you can show them how they can leverage those dollars and get a lot more bang for their buck, or maybe set aside a lot less money and be able to spend some of what they had previously set aside just due to the leverage. Now, single pay products, I mentioned we have some that are other than Genworth and the TLC. We do offer the Money Guard from Lincoln Financial. That has a benefit of not having a pyramid exam tied to it. It's non-medical underwriting. Same thing with the Lifetime Return Select from National Western. These are all based on a UL chassis, and it's a modified endowment contract. So we lose the tax favored status if we're trying to pull money out of the contract, but it really doesn't matter because we're not going to be taking loans or withdrawals, and very rarely do we see gains. Most of that money is coming out of the fund to pay the cost of insurance every year. We also have one carrier that has a similar product on a whole life chassis. That's through State Life with their asset care. And I'll talk about this in a webinar next week, but they have a unique way of moving money into their product from qualified plans and also from non-qualified annuities, and they make it real easy for the client to do that. Now, I want to give you an example of a multi-pay product, and we're going to look at that same benefit amount so you can compare, well, what would it cost for the same client if he or she was looking at either product. So previously we had a male 60, he had $100,000 he was going to pay as a one-time premium to give him about $600,000 of LTC benefit. And I forget which carrier I used here, but this same gentleman could pay about $9,000 a year for the rest of his life on a multi-pay basis, and he would have that same LTC benefit, just over $600,000. And the way most of the multi-pay products work, you don't get the extra leverage from the death benefit to the LTC. The death benefit and LTC are one and the same, so he does have a much higher death benefit here in this particular scenario. And the funding sources for these multi-pay products, maybe we're just moving money that was currently going into an old-fashioned policy. Maybe it was a life policy that did not have an LTC rider. Maybe it was a traditional LTC policy that didn't give the client any sort of a benefit if they never used it. So we can redirect some of that money Maybe it's coming out of their regular income. In fact, that's the usual source. You might have some folks that are taking required minimum distributions from qualified plans, and they may have savings in other places as well. Now, the next part is I want to go over some of the differences in the features of the riders that you see on the life policies, because no two are exactly the same. But there are some different ways that carriers will pay out the benefit to your client. And probably the most common way is to express that benefit as a percentage of your face amount per month. It's very common to see the benefit paid out at 2% of your face amount per month. So if you had a $100,000 policy, your client would receive $2,000 per month as a benefit. If you double your face amount, you double the monthly benefit. That's pretty easy for a client to understand. It's most commonly used. Some carriers allow you to raise that to 3% or 4%. If you do, it does cost a little bit more for that rider. At least one company we work with here, Protective Life, allows your client to name their monthly benefit amount, and it's whatever specific dollar amount they want. If they want $5,000 a month or $10,000 a month or $8,000 a month, obviously the more they take, the faster they will go through their death benefit. If they have specified $10,000 a month in their policy and they don't need that much, they don't have to take it, but it's available for them if they would like. The more they would like to have, the more the rider is going to cost. This is another common way of determining the monthly benefit amount. It's an annual benefit or a monthly benefit that's determined by both underwriting and actuarial factors. Now, this is a little harder for a client to understand, but the way some of the carriers will handle their benefit is that when the client goes to file a claim, the carrier will look at the maximum amount available for the client in that particular year. It might be 24%, it might be 80% of their face amount. And then what they're going to do is whatever that dollar figure is, they're going to look at the client's life expectancy and current interest rates, and they're going to figure out, let's say your client had 5 years left to live. That's their expectancy. They're going to look and see, what could we have made on this money that we're now giving to your client over the next 5 years at current interest rates? Now, that's what the company is losing by giving that money out. And so whatever that figures out to be, that's what they're going to keep, and the remainder will go to your client. So, the bad part about this is your client will never know exactly what they're getting until they file the claim. You can kind of guess, but you can't ever give them an exact number. And there's one or two other carriers out there that will follow a fourth method of calculating, and it's using a one-time benefit, once again, determined by underwriting and actuarial factors. So the plus for your client there is they can get a huge lump sum. The minus is, once again, they won't know exactly how much it is, and it's just a one-shot deal. Not many carriers do that. We have several multi-pay carriers here at Financial Brokerage. In fact, it's getting to the point where I'm just going to have to list every single carrier we have out here, because so many of them offer some form of a long-term care or chronic illness benefit. Now, I'm going to talk briefly here about term life. And yes, this is something that's available on some term life products. It's, I think, a great starter policy for a lot of folks, just as we traditionally sell term to younger folks with lower incomes with the thought of maybe converting all or some of that later or selling them a permanent policy later. You can use the same strategy with the linked benefit plans. The term policies are likely going to expire before your clients get to the age where they're going to use the LTC benefit. And none of the term products that have these riders are convertible with that rider included. You can convert the life part, but the rider stays put. So they're good as starter policies. Several of them have a critical illness rider as well, and I think that's probably the more sellable rider. It's really easy, or a lot easier for a 30 or 40-year-old to believe they might get cancer during their working years, more so than to have some sort of a long-term care event. Now, something else I want to mention about term insurance, I mentioned none of these four allow you to convert the rider to a permanent plan. There are 2, maybe 3 carriers now that do allow you to have a LTC or chronic illness rider on your converted permanent plan. So your term didn't have it necessarily, but it can become part of your permanent policy when you convert without any additional underwriting. Most carriers won't put that on, but if you're looking at North American within the first 5 years, it's on there. If you're looking at AXA within the first 5 years, you can have the LTC rider. And if you're looking at Mutual of Omaha, their chronic illness rider is a part of all of their UL products right now. You get it whether you want it or not, so you can convert that term and have that coverage on your permanent plan. Now, this next section I'm going to talk about is probably the major difference between these different riders. And I guess it's one of the four in here. We're going to go over several of them. But let's skip ahead here, because this is really an important one, the tax codes that are used to define the type of rider. There are two types. There's the LTC rider you see on the left. That's lit under the tax code. It's 7702B. Then the chronic illness riders are on the right. That's under the tax code 101G. All the carriers you see with these riders have to file their rider as one or the other. And there are some things that they have in common, qualifying by loss of 2 of 6 ADLs or severe cognitive impairment. But only the true LTC riders can be marketed as long-term care riders. The chronic illness folks can't use the words long-term care in their rider. The true LTC riders are usually done on a reimbursement basis, and those are the ones where you'll see that extension of benefits where your LTC benefit is potentially greater than the death benefit. That's probably the little higher quality rider. The 101G or chronic illness riders, like I said, they can't use the words long-term care in any of the materials. There's generally less restrictions to the client on the use of the proceeds. So most of these are an indemnity benefit. So if you're getting $5,000 a month, you're getting $5,000 a month. You don't have to prove that you had $5,000 of expenses. You don't have to prove who was providing your care. The money is yours to do with whatever you like. So the client has a little more flexibility there. Your benefit is limited to just the death benefit. You can't have more. And the fourth point down there, that's probably the only downside here, is that in qualifying for benefits, your condition has to be deemed to be permanent. They don't think you're going to get better. You're not going to regain your ADLs or your cognitive abilities. If you have a true LTC rider, let's say you broke a hip and were in the hospital or needed care for a period of months, and they fully expected you to be out there and walking around a year from now. Well, you just might qualify for benefits if you had a true LTC rider. If you had a chronic illness rider, there's no way they're paying that out to you because you're going to get better. So be careful when you're looking at these. There's usually a trade-off. The chronic illness riders tend to cost a little bit less, but you do have a little bit more restrictions there. Now, I'm going to go back a slide. I talked a little bit about reimbursement and indemnity benefits. Not many carriers follow the reimbursement model, and it is convenient for the client because the insurance carrier can work with the provider and handle the bills that way. Your client doesn't have to worry about that. But most of the companies use the indemnity model where your client is going to get that full lump sum to do with what they want. If they want to have care in the Bahamas, hey, they can go there and do that, and nobody's going to say anything about it. Another major difference here is the need for long-term care continuing education credits. Now, some of the carriers require it. Usually it's the carriers that have that true LTC rider. In fact, I'll tell you, any carrier that has a true LTC rider is going to require that you have that specific LTC continuing education, and a few of the chronic illness rider companies will want that as well. That part does vary by state, and you can see there on the right the carriers that do not require you to have that. Most of these products we've been talking about on the life insurance side anyway do require a full pyramid exam. Now, if your clients don't want to go through that for some reason, we might look at some of these others that are usually the single pay variety, where it's streamlined, simplified underwriting. And we have several carriers, as I mentioned earlier. It's getting to be almost all of them now that have some sort of a rider available. So that's the conclusion of our webinar. You can type your questions in at the bottom of the control panel on the right, but to kind of wrap this up, we know that our clients need protection. The high cost of extended care is probably the greatest threat to their retirement assets that they're going to face. And you can really offer them protection in any form they prefer. If you can build up enough money to self-insure for them, hey, that's great. If they'll go for a traditional LTC policy, that's fantastic. But we want to make sure that you're talking to them about annuity and life insurance-based LTC solutions, because this market is just growing by leaps and bounds for all the reasons we've discussed here this morning. And before I get to the questions, I do want to put in a little plug for a webinar next week. I'm going to be taking the linked benefits up a notch, and I'm going to be presenting what I call Linked Benefits 202, 5 advanced concepts. There are really some little-known concepts in this marketplace, and we'll talk about how you can use qualified money, some interesting ways to get coverage for an uninsurable spouse, and also a very unique way to combine an annuity and a life-based hybrid product together. So we'll take a look at the questions here, and between David and I, we'll see if we can get them answered for you.